All right, good afternoon, everybody. This is Gavin McGuire, event trader, just about to be joined by Brett Manning. Brett, you there with us?
Yep, how you doing?
I'm doing okay. How are you doing today?
Doing pretty good.
Yeah, I think both of us kicking ourselves for missing the short here.
Yep.
Um,
But you know what? The setup wasn't the one that I wanted, and that's just the way that I deal with things. And so I don't really, and I've stressed this 1,000 times before, but just to redo it, um, I never really worry about missed opportunities if it wasn't really my bread and butter setup, because worrying about that makes you take bad setups in the future.
right, the idea that you're chasing.
Well, it just that it wasn't what I wanted to see. I wanted to see a lateral consolidation after the initial breakdown, which left us with there was a pattern coming together on the hourly chart which showed me that break under 7,800 wanted to happen, but I wanted to be able to understand how to position myself so that a 20-point bounce was falsifiable. So I needed a pattern because it didn't have to happen, that breakdown. So you need to be able to put a risk point in place that's actually a falsifiable setup. And if I just barreled in short when I first pointed it out, if that had bounced 20 points, I would not have been in a situation where I'd want to cover. In fact, that's where I'd want to be shorting. So it puts me in that difficult philosophical conundrum of having to put my stop right where I want to be entering the short. And that just doesn't work out. So if it had given me the setup, maybe gone sideways, bounced a little bit, formed a little bit of a descending triangle along 78.50, that's the entry. That's the one that I wanted, and that would have been a really sound setup. It would have given me a 4, 5, 6 to 1 ratio on the short. And if it doesn't ever give me that setup, then it isn't there. Just because the market went down doesn't mean I missed the opportunity. The opportunity never appeared. The market happened to go down, but if I start kicking myself over that, then I'm more likely in the future to be less disciplined about waiting for the opportunities that I understand well.
Right. I know for me personally, I just wasn't seeing much of a much buying going on over that 3,000 level. We'll get into that with some of the flow because given some of the data, I would have expected a little bit more buying going on there. However, what I was watching was that 29.85 level. When we came down to test that myself, I was just waiting to see if that would hold, and I was talking with Scott on the air about this and looking for a move back up to that pivot level of 29.96, and probably got a little greedy and only got up to that 29.90 area there. In terms of the catalysts, Brett, do you think that it is some of this impeachment hearings that we're hearing? I mean, just in terms, I know you don't like throwing a narrative on every move, but there did seem to be something that set off the selling to a certain degree, and I'm just curious is if you thought there was any smoking gun, or if this was simply just people that were not seeing the buying above 3,000 and decided to maybe bank some profits.
I think that it's a mix of things. I think that the consumer confidence number was actually pretty important this morning. I think that that's when you saw the yen take off, is right after that came out, and I think that probably it's the sense that if we're in this continuing kind of reacceleration sort of environment that's been showing up in some of the economic surprise indices lately, then people are willing to take a little political turmoil. But if suddenly the cycle's at risk, then things compound. You're easier to shake out. So I think probably some of the politics narrative and crosswinds played into things, but it was initially set up to be more vulnerable because of the consumer confidence number we saw. And as we've seen lately, as there's less and less faith in monetary policy resources to come to save the day, there's more of a direct relationship, I think, between economic data and market outcomes. So we're seeing market weakness on weak data rather than the idea that that's going to make more rate cuts more likely.
Right. One of the things too, Brett, since I know one of the things I wanted to ask you about was that Citigroup Economic Surprise Index, and we could break into that, I suppose, now since we brought up that consumer confidence number. One of the things that was sticking out to me yesterday was the PMI reading, the preliminary PMI reading. And what jumped out to me was the comments around the jobs market, which I thought really sets up for an interesting September jobs report. Did you happen to catch my comment on it yesterday?
I did, but you'll have to refresh my memory.
Okay, so basically they said, I got it right here. Um, where is it? So basically, what they were talking about was latest data also signaled a sharper decline in backlog of work, thereby suggesting a lack of pressure on business capacity. Nothing new there. Some companies responded to subdued demand conditions by cutting back on staff hiring in September. The latest survey pointed to a drop in private sector payroll numbers for the first time since January 2010. And I got to think that that's setting up potentially for pretty low expectations around the September jobs number. Would you agree with that, or?
Yeah, I mean, I get what you're saying for sure. Yeah, I think the surprising thing has been the surprises in the other direction, given that we have this sense of a an unending trade war that seems to be, no matter whether there's agricultural goods purchases or not, the sentiment around it is very, very clearly, most money managers expect this to be with us at least through the election. And you know what the impact is on business investment and spending, and that's clearly something that can become contagious. And if we're starting to get to the point where there's less likelihood to expand headcount, that's just another business investment. So I think that there's an easy path there to see that start to eventually impact the labor market. And I guess, yeah, I mean, I think that first Friday early next month is going to be pretty interesting.
Right, and something we're going to have to obviously be on the lookout for. Pulling on this piece from the Sentiment Trader, I noticed that the soft versus hard data moved into excessive pessimism, which
Right.
is something we had been discussing. But I guess this would be just a laggard then to that Citigroup economic indicator as well as the Bloomberg economic indicator.
No, I think that no, I think that it's saying something similar. I think that it's saying, well, I mean, it's making a distinction between things like consumer surveys and something like retail sales, but I think it's saying that this is actually positive because it's the hard economic data surprises that have been most significant. So that moves it into a buy territory.
Okay. All right. So basically, they're just looking at the soft as the survey, where the
PMIs
hard
have
is
been
the act.
disappointing.
So
PMIs have been disappointing, but retail sales have been doing well. So
right.
they're
Okay.
balanced.
Okay. So
Yeah.
basically, the idea that people are just overly pessimistic and it's not bearing out in the hard data.
That could be right. That could be the turn, is that you see things like exactly what you just read off about the jobs market, and then we get to the jobs data and it's great. And you get enough of those moments that eventually the sentiment shifts back the other way, even among people. But the other way to look at it is these surveys could be leading indicators, and the hard data ends up getting worse.
Sure.
That it can go in either direction here, and at this point in the cycle, it certainly can go in either direction.
Yeah, and I guess that's one of the things that makes this PMI reading of great interest ahead of that jobs report, and we'll have to
Yeah.
keep an eye out for.
Right. I mean,
Um,
retail sales is going to hold up until people are losing their jobs. So
yeah.
you know which one is going to come first.
Yeah, yeah.
Yeah.
Well, and I was talking with Jim about that being, the chicken or the egg um, argument, which we've seen this plenty of in a lot of the sentiment data, and that's services versus manufacturing. This morning's German IFO survey just being the latest one, where services were outpacing manufacturing. And the question is it the services that will lift up the manufacturing, or will manufacturing job losses pull down the services? And I think that's why we're going in a sideways direction until we get a better idea of who's going to win out on that.
Well, in philosophy, there's a constant debate between dualism and duality. And dualism is essentially a synthesis of duality. So basically, it's like saying, is it the heads or the tails? But the reality is it's the coin.
Right.
It's both are self-reinforcing feedback loops. So both can augment each other when they're moving in a certain direction.
Okay. Since we're kind of on the sentiment data front here, Brett, we'll just go over that. Now, there wasn't anything that was really sticking out too much to me out there. The small trader put buying is in extreme pessimistic territory, but that was similar to what we were seeing last week. Was there anything in that sentiment data that was jumping out to you?
No, I mean, so what the narrative to me, the last time we talked, pretty similar narrative. Since we talked last,
Yeah.
today is the only day where there has been any kind of significant market movement, right?
Yeah, I saw something. I think that the market in the past 2 weeks, the market, the S&P 9-day range has fallen below 0.6% as the max minimum, which just kind of highlights what you're talking about right there.
Yeah, sure. So, right. So, what we have is a situation where the last time we talked, the highlight of our conversation was that there's largely neutral readings, except for there are some short time frame signs of complacency. When you look at things like VIX term structure, at that point it was SPY liquidity premium. We had something else in there, maybe it was building inverse ETF shorts. There were a few things that were in the red that are normally short-term indicators that could signal complacency. A little bit of a reduction in hedging, a little bit of a reduction in exposure to downside while we sat in that range. That's where we were last time. So I was looking at today's action with the sense that when I saw us start to roll over earlier, and I put out that kind of radar comment on the NASDAQ that I didn't end up taking and that you could look at as a missed opportunity at this point. The idea was that if we start to see some of those range lows start to come into question, given the tails down there, and given that prior breakout, I posted a chart earlier for anybody who wants to take a look at it, showing my outside target. That's a 1351 comment on the site, but the chart shows you the dynamic in play there, which is essentially we have this really important range breakout, September 4th, September 5th, and when you start to get a little bit of downside momentum, there's some big stops that come into play. And because we have seen a reduction in assets flowing into inverse ETFs, we have seen a VIX term structure that's gotten a little bit complacent. We have seen no real premium placed on the large ETF trading versus less liquid stocks. All these little kind of short-term sentiment indicators come into play. You're more likely to get those levels busted and hit the stops on the other side of them and flush through. Even if there's going to be no downside follow through from here, that becomes an easier objective for the market to reach when people aren't already stacked up with short-term hedges. So they're going to be more likely to hit the sell button as their stop goes through, because they're not sitting there with a bunch of exposure to an inverse ETF or whatever. So that plays into the same thing where you've got to shake out this complacency and then rebuild from there, if indeed we are still in a relatively bullish situation technically, which we could be if we recover later today, certainly, or tomorrow.
Okay, just while we're talking here, Brett, we talked about that pop-off to 2960 area on the headlines that Trump would be releasing his transcripts. Now we're getting a roll back over. Not a big surprise, but I guess there is a Washington Post tweet going around that House Speaker Pelosi does plan to announce a formal impeachment inquiry of Trump. This is after resisting for the past couple of months, so it does look like the House is going to push forward on that. That's most likely what the market's going to be expecting to hear announced after hours. So we'll continue to keep an eye on this action as we talk. Let me ask you this, Brett. Gold, I know that's a position you tried taking a short in late last week. You didn't have much of a risk in there, so you got stopped out for a small loss, I believe. Gold's marching higher today, and one of the things that I was seeing was, something from the sentiment trader about inflation-adjusted 10-year Treasury yields turning significantly negative in the past, which has often marked the multi-year tops in gold. And they note 1974, 1980, 2012, and 2016. This was the case. Obviously, a lot of headline risk out there. You've been talking a lot about the positioning in gold, and I believe you said it's at all-time highs, but that's also,
it's right testing it. It's right at bouncing around all-time highs in terms of speculative.
In terms of spec contracts, but that's a little bit misleading. You were saying too, is that's just kind of there's more contracts involved in the space too, correct?
Mildly, but I think
okay.
as a comparative to the summer of 2016, I don't think that it is. As a comparative to 2010, it's a little bit. Probably there was more fervor in when gold was moving up to near 2000 level. And certainly there were other instruments, so probably the comparison between 2010 and now is a little bit distorted by an increasing financialization of the gold futures market. And certainly when you're trying to compare it to like 1978 or 1980, that comparison is completely invalid. But I think the comparison of 2016 is not invalid. And I think that there's a mild comparison with 2010 where you might say there's a tremendous amount of speculation right now for gold to move higher. It certainly is still unquestionably a crowded long position right now. And there's lots of reasons for that.
But today's headlines that we're seeing, we just posted that headline under the SPY ticker. Obviously, gold becomes a little bit more of a safe haven when you start seeing something like this. How does that impact your philosophy around this? I know we were talking about this, and I think it was 2014 when we had Russia invading the Crimea. And,
Sure.
it was a pretty similar case to this in terms of the positioning, but it was very difficult entry at that time, just because every other day you're hearing something about Putin and Russian tanks going in to the Ukraine and everything. Now, you ended up making a killing on that. So with that in mind, how are you approaching this? Are you waiting for spikes on headlines to kind of nibble away and just kind of do a lot of trimming and trailing in that aspect? Do you have any game plan for this, or are you just kind of letting this play out here at the moment?
For now, I'm letting it play out. In 2014, we had a big time frame pattern that was spectacular for that short. So it was spiking to the upside inside of a very bearish larger time frame pattern. Right now, we have an upward trend. It's coming into it's got some reasonably important resistance levels that it's dealing with. The main thing is it precludes me from trading this on the long side. And if it happens to give me a short time frame setup where I look like I can, risk 8 points to make 40, I'll take it because there's a speculative position there that if the pattern starts to show. So what the pattern does is.
And which pattern do you want me to have up here, Brett? A weekly, a monthly?
Well, there's no pattern. There's no pattern.
Okay.
So I'm talking very in the abstract. But the concept of the importance of the pattern. I'm not going to take the short until there's a pattern that tells me to take the short. But this sentiment data, the speculative interest situation, just keeps me out of this long. I took the other long because there was a large time frame pattern, so it was kind of the opposite of the 2014 setup. There was a big bullish pattern a few months ago, and we capitalized on that tremendously because we had a low speculative interest level and we had a big long-term pattern showing, the bullish breakout coming. So that was a good long side setup. Right now, we have possibly trend continuation play. You have possibly a momentum setup. But for me, it's past my threshold when I see it this crowded. I need to see it shaken out powerfully. Even if I don't see the follow-up CFTC data show me that it has been, let's say it knocks off $100 in a just a tanking move here. But let's say it moves back under, it rolls over, and overnight, heading into the China session or something, we break down through 1500, and tomorrow we're sitting here having this conversation at 1440. I don't need to see the new CTFC data to know what's happened there. Like, we have just thrown out 50,000 of those long positions. I know that. And I know where their stops are. I know where they're going to be. I don't need to see, and that's an important point. The edge comes from experience. I can use inductive reasoning here. I don't need to see a publicly available data point to know what's just happened if we get that. And once it's a publicly available data point, it's not going to be worth as much. So I'll be buying gold at that point if we see something like that. But I feel like we need to see something like that in this market to purge out a lot of these weaker hands that have gotten involved on all the articles being published everywhere about how here's the new next great heyday for gold. It's headed to 2,500, 3,000, whatever. We need to see this. I mean, when you look at small specs and large specs together, it's like 330,000 right now, just net long, just all piled into the same position. The producers are more than happy to sell their gold in the ground right now to them to let them gobble that up. We need to see that shaken out and balanced back a little bit, and then I think that there will be interesting opportunities on the long side. But we don't have a pattern, and this is what I initially said, where this scenario becomes activated for the short. I need to see that there's a system of a sequence of orders, a sequence of transactions, and a character, a personality to the tape in that market that starts to show me that there's a force that's going to make that shakeout happen, that's going to precipitate it, like rain appearing out of the sky. There needs to be something that starts to precipitate that shift in the small time frame tone of the chart to allow some levels to be taken out, to allow some of the weaker hands that have piled in to get spilled out of those positions, to hit the trigger and give up. We need something to start moving in that market to show me that that's the case. And that will be shown by the chart pattern. If we start to see, when you get good headlines, maybe it flashes up for $10, but that's inside of, a descending triangle on the hourly chart that starts to take shape over the course of 3 or 4 days. Something like that then shows you where the trigger levels are, shows you where you need to put your risk to have a falsifiability point, and you get a setup. And the setup is sort of the fundamental unit of this. And right now, the positioning is predisposed to create a shakeout opportunity on the short side if the pattern will appear to form a setup to take advantage of that. And after it, I think it could be violent. And after it, I think that you'll have some interesting long side setups in that same market again. That's my bias right now. It is very possible that this just continues to plod higher. We get to 500,000 net spec long contracts at 1750. That's definitely possible. I'm not saying that's not going to happen, which is why I'm not shorting it right now into the rally. That's just not how I operate. I would need to see the personality of the market start to match with the idea that the shakeout is going to happen here rather than later, and at this level of exposure and positioning, rather than a much greater new all-time record of spec positioning on the long side.
All right, so let's get into some of the flow data that we were seeing from the latest Bank of America flow show there. Weekly flows of $19.2 billion into equities, $6.6 billion into bonds, $0.1 billion into gold there. There's been $34 billion of inflows to stocks over the past 2 weeks versus $10 billion in redemptions from government bonds. This is pointing towards a risk on underlining flow that's going on in the markets, obviously not being shown today. So where do you think signs of this money coming in start showing up in terms of support levels and stuff, Brett?
Well, so I think one of the things that they're showing up in, and I mildly mentioned this morning, is in the parts of the market that are outperforming when the market is doing well. It's a little bit more cyclical, a little bit less what I think of what we've developed in this market for a while now is kind of a barbell strategy of risk-averse positions matched with high-growth technology. It's been like buy healthcare and Walgreens and Roku. It's been that kind of combination of like sort of persistent growth, thematic growth matched with defensive stocks. That's been kind of that's gotten us through the majority of this year in a lot of ways.
Right.
And shifting to beaten down energy stocks and industrials and getting rid of the new thematic, like the cloud services plays and the Walmarts and, shifting over to, Caterpillar and materials plays and stuff where you have to have a strengthening economy for those to play out. Now, relative to the economy that we have, they're undervalued. They're sitting in a position where if you thought there was going to be economic outperformance, these are obvious, positions to take on for a bottom-up stock-picking fund manager. Those are the positions to move your money into if you think that we're going to continue this trend during the rest of this year and early next year of seeing more positive, hard economic data than is being expected or than is priced into the market. I think that's one of the shifts that we've seen. This sort of growth plus defensives rotating into value cyclical, right? So there's been that kind of transition going on. And I think generally speaking, this thing that we talked about last week, we got back after Labor Day and we start to see this outperformance, and we start to see a reduction in recession forecasts, and we start to see flows into stocks and out of bonds. And it's the same kind of rotation as going from, Roku and Walgreens over to Caterpillar. It's the same kind of rotation to go from a bond-dominated portfolio into an equities-dominated portfolio. So in the last couple of weeks, we've seen $34 billion come into stocks. That's the most all year. So I think that there's that there that's trying to happen. But then we see today's consumer confidence number. And, what if we're headed toward, just like you said, starting next month off with our first bad jobs report in a long time? Then maybe all of that changes again. And I don't have a crystal ball. I don't know if that's going to happen. We've got a mentality that's trying to evolve into being right now, which is a more cyclically oriented bet on a reacceleration of the cycle. Maybe given all the easing, who knows? But it's trying to happen, but it may be that it's going to be weathered back out of the picture by kind of a resumption of a feeling of cyclical risk.
I think one of the more interesting stories that I read this morning, Brett, I don't know if you happen to have come across it, but it was a Financial Times story talking about insider stock sales at a 2-year high right now. Some of the
that's interesting. All right.
So some of the notable names that were on this list for anybody keeping track out there: Walmart, Lululemon, and Estee Lauder. Walmart and Lululemon being two of the strongest names out there. They sold a combined $19 billion of stock in their companies.
This was FT?
This is Financial Times, correct?
Okay. Yeah, all right.
I'll shoot you the link to the story after it. Again, they were selling it at the fastest pace in 2 decades. It's at a 2-year high. And basically, they sold a combined $19 billion of stock in their companies. This is corporate insiders, usually viewed as CEOs, CFOs, board members. Right. Sold a combined $19 billion of stock in their companies through mid-September, according to data from Smart Insider, which is a UK-based group. That puts them on track to hit about $26 billion for the year, which would mark the most active year since 2000. Obviously, the internet bubble there, when executives sold $37 billion of stock amid the giddy highs of the dot-com bubble. The projected total for the year would also set a post-crisis high, eclipsing the $25 billion of stock sold in 2017. So
there's ominous something, but it's also a sentiment data point. And while they did good in 2000, there's been a whole lot of times in history where insiders are buying stock and selling stock at exactly the wrong time. So take it with a grain of salt.
Right, but still, I thought it was a pretty interesting read.
Yeah, me too. Yeah, I agree.
This high level going in there. So, we see the $34 billion of inflows coming in, and one gets the idea that perhaps it's the people in the know that are selling it to them, right? So, just something we want to keep an eye out on. And again, 3 of the names mentioned in that story for people curious: Walmart, Lululemon, and Estee Lauder. All right, so Brett, let's get, we're about 30 minutes in. I want to spend the last part of this session discussing some of the things we've been talking about with monetary policy and fiscal policy. Before we break into that, is there anything else on the flow front that I missed that you wanted to make mention of?
No, I think it's a pretty simple. I think we've covered it. That you guys, if you were listening to it so far, this is a simple environment to decipher in terms of sentiment. There's a lot of neutrality. There's a lot of short time frame complacency, and there's a lot of flows that want to push the market higher. And we've just got some headlines to help shake things out. So you would want to be, all other things equal, relatively bullish of mind, except you have lingering out there this idea that this attempt to push back into cyclical positioning is extremely misguided in terms of timing. And that's something, you're not going to have a crystal ball. But if we do, again, see, one point I made earlier is you have an environment where you're not seeing the bad as good dynamic at all. So if we're heading into worse data, then the sellers are going to win in that equation right now.
Right. Okay. So let's break into. It was a topic we discussed last week, Brett. Now we're starting to see a lot more discussions around moving away from monetary policy to fiscal policy. So just to kind of recap things here, the Fed cut rates last week. This made it the 43rd rate cut year to date for central banks and the 751st rate cut since the Lehman episode there. We of course this is on top of the ECB with their 20 billion of QE that they announced last week. There's the Fed liquidity operations, although I'd look at that more as structural. This brings the G5 central bank balance sheet by April 20 to a peak of approximately 16.6 billion in or sorry, to about 13 trillion, I should say, in financial assets that have basically been purchased since 2008.
And let me interject one point.
Sure.
Given the reason for a debate that we're just about to discuss is, given everything that Gavin just said, since the time frame that he's talking about, so since the financial crisis until present, interest rates have gone down.
Yeah. And with that, Brett, you sent off a piece to me that was fascinating, I thought, and that was a white paper by Blackrock talking about some of the potential next steps that could be taken. I shot you off this morning Goldman Sachs's study into some of the fiscal policy, and the Fed, of course, just recently put out a research paper looking into negative interest rates, and it seemed like a lot of them are coming around to the same idea that there is a general need for fiscal policy to come into the markets in order to offset, as you said, all that activity that we've talked about, and yet there's been no move in inflation, no move in interest rates, and it really suggests that monetary policy has kind of hit its wit's end there and are relying on fiscal policy. Now, the BlackRock paper was kind of centered around a discussion of monetary policy and fiscal policy working step by step, basically allowing the ECB to monetize a fiscal policy plan. I'd be curious as to some of your takes on that and some of the more interesting aspects you were seeing in that BlackRock paper.
Well, so I just want to go back to the conversation we had right in front of Jackson Hole, where and I've referred to this a couple times because I think it's just my framework for thinking about it is kind of to filter through some of the conversations that you and I have. And one of them was about coming into Jackson Hole. How could there be a game changer on this front? And this front is just what he just said. There's this gigantic effort that has happened, quarter in and quarter out around the world among central banks over the last 10 years, and interest rates have gone down in that time. And long-term inflation expectations have gone down in that time. So whatever it is that we're doing, maybe it's working, but if it's working, then in the absence of it, we would be in something that is, would dwarf the Great Depression from any, basic standard analytic point. So there is a deflationary pressure that the typical and standard tools of monetary policy don't seem to be able to impact. And the metaphor that I used last week, and I'll bring up again, is monetary policy and the standard tools that we have. At this point, in that group is now quantitative easing, I would say. We've got forward guidance, interest rate management, and quantitative easing, asset purchases. And those are sort of the standard set. And to me, all of those things are like voodoo doll magic. I can make a little doll of Gavin, and I can take a pin, I can poke that doll in the shoulder, and if Gavin sees that and he happens to be a believer in voodoo magic, then his shoulder is going to start hurting. But if he doesn't believe in voodoo magic, it's not going to impact him at all. And monetary policy kind of works that way too. You need to be able to move symbols around on the side, have people see that, and react to it in terms of their decisions in the real world. And fiscal policy is arguably just stabbing Gavin in the shoulder with a pin. It's going to hurt. It's going to be obvious. There's no way he can get away from it. It's going to happen to him.
And I think one of the key aspects of that, Brett, is that it's precise.
What?
Fiscal policy.
It can be, yeah, if it's managed properly. I mean, it's up over
managed properly.
Yes.
I mean, you could.
I can stab you
hand
right
that
in the
to
shoulder.
Somebody.
Yeah,
it's shovels in the ground type things, as opposed to the more trickle down theory of a monetary policy. Would you agree with that?
Yeah, sure. And so the Jackson Hole conversation we had is Powell's going to stand in front of everybody and try to make a case that there is a safety net. And I mean, we're not in dire circumstances right now. The data, as we've just described, has been beating expectations since then, roughly, and it's been doing so more on hard data than soft data. So taking sentiment away, the economy is actually performing well since that point. So it hasn't really been put to the test. But if it had, I think that there would be a problem right now because he didn't bring anything in front of people at Jackson Hole in the more philosophical conversation that suggests that there's a real safety net, that there's an effective one. We see in Europe there's not. We see in Japan there's not. So there's got to be, and I called it in our last conversation right in front of Jackson Hole, I called it a thing, in quotes. He's got to be able to stand up in front of everybody and say, we've had these other tools, they're hit and miss, but now we've got this thing. And you don't have to worry about it. It's this sort of Hank Paulson bazooka. If you've got it, you maybe not have to use it, but people have to believe that there's something there that you can do that's got potency, that's got impact. And that faith in voodoo magic has been one of the defining aspects of this cycle is the process of people losing their faith in voodoo magic. So the Blackrock paper and a number of other things coming out from lots of people at this point is all sort of a scramble to define the next horizon. Clearly we're at that point where we're evolving into place some new set of tools because the tools that we've used in the past don't seem to be working anymore. So we need to move beyond the voodoo magic tools, and the Blackrock paper is really about setting up a system of coordinated control, targeting fiscal policy enabled by the central bank. And I think that it's just the beginning of a number of different papers that we see like this as people start to get ahead of themselves in foreseeing the end of this cycle and realizing that there is no safety net under things. And no safety net under things does mean that we're going to have more pockets of more extreme risk aversion. And another metaphor that I use, just to belabor the metaphors here, is trapeze. Trapeze performers at a circus will do much more complex tricks if they know there's a safety net below them. And if there's not, they're going to be pretty conservative in what they do. And I think things like PE multiples are going to be like those tricks. So until we get some kind of understanding that there's a safety net below the market, it's going to be much less aggressive probably in terms of how it reacts to even positive scenarios.
Right. So what would you be looking for in terms of when some of these items could start getting introduced? I think one of the bigger speeches we talked about the jobs report coming up, and a couple of days after that, on October 8th, Fed Chair Powell has a speech that's obviously going to be pretty highly anticipated by the markets. I think the one unfortunate thing is that it'll probably come a couple of days ahead of Liu He meeting with Mnuchin and Lighthizer. So I think we'll be in a little bit of darkness around some of the trade as well. But you got anything that you'd be paying attention to from Powell in particular, but Fed officials? We've seen a lot about the price targeting from Williams, so I don't think that would be a new concept, but that would certainly fall into probably some of the ideas that are being put in place by this BlackRock paper. But was there anything in particular that you'd be looking for in commentary from Fed officials that could suggest that they're looking at this? I know there's been a lot of talk about the Fed and that they are running these, I forget the name of the program, was it We Will Listen or something? Brett, do you know what I'm talking about? They're holding those hearings with people.
Yeah. Absolutely.
So anyway, I'm curious if, obviously you'd think that somebody from BlackRock's got some influence going in onto those hearings. So what would you be looking for in statements of Fed officials that would suggest that this is a serious undertaking that we could see moving forward?
Well, I'll tell you the answer to the more simplistic version of your question first, which is when would we see something like this be seriously considered and implemented? And if history is any guide, the catalyst for that will be crisis, and it won't be before. And this is more, I think, setting up an intellectual foundation so that because people they're not going to be proactive. There's too many reasons to be conservative and not want to carry all the blame for some terrible thing. So it will be when we're seeing some kind of unquestionable and unequivocal sign of problems in terms of the cycle before there is any real, I believe, public presentation of a true strategic implementable idea, a version of what we're seeing come out of some of these more sort of thought pieces that are being constructed. But I think that it's really important that people are starting now to lay a foundation so that it feels like it's not just shooting from the hip when it's time to start to use some of this stuff, which I think will happen at some point. But I'm sure, if history is any guide, that the catalyst will be when everybody's in a crisis state. And somebody I conversed with quite a bit just brought up to me that political dysfunction is a part of this. Like, you're going to have to get people on the same page on both sides of the aisle, probably, to get all of this to happen.
Well,
Again,
that's kind of the part of the Blackrock paper, though. You could avoid some of that political dysfunction by putting this in the hands of the Fed.
Yes, some of it, but they still have to agree to put it in the hands of the Fed.
Right, right.
So there's going to have to be some kind of participation there. But again, I think that the cure for that is crisis. Like, it always is. So, you've got political dysfunction and an unwillingness to go in and use rash solutions until you get punched in the face. And then, everybody's on board pretty fast.
Right, yeah. And, that is kind of the downside of this, right? There's the part of that Goldman Sachs paper that I was talking about from earlier in the day was talking about what would get Germany to move, and in terms of fiscal policy, and that'd probably be a pretty good initial take on the impact of fiscal policy and whether or not it could work, and that is simply further downside. And we're looking at a country that's going into recession, and they're still not ready to pull the trigger, and they're sitting on a surplus. So the political landscape certainly remains one of the key items here.
Absolutely. Here, hold on one second. You talk. I'm posting something that people are asking about.
Okay. So as Brett and I were talking about, this whole debate between monetary and fiscal policy is going to really continue to be a key area in the markets moving forward. So time. Hold on a second. Okay, just making sure if everybody's able to hear us. If you can respond, I'm just seeing some issues about a server connection here. For those asking about the Blackrock paper,
I just posted it.
Oh, you did? Okay. All right. Okay, bro. Just making sure everybody could hear us okay. Just saw something going on with the server there. But, this monetary policy versus fiscal policy is really going to be at the center point of arguments going forward, and certainly if we see any further downturn. So I think it's going to be one of the more important things to continue to discuss. One thing I did want to ask you about on that Blackrock paper, Brett, do you have any thoughts about two possible links for the slowdown in inflation? One has pretty much been laid out, and that is, of course, global production and technology. Ironically, the global production could be what reverses inflation, right? If we can keep continuing to see these supply chains going through and tariffs going up, that's the whole point of those. But do you have any thoughts on that self-fulfilling prophecy in inflation? And that is basically BlackRock's argument that people who expect inflation to be lower in the future are willing to hold off on purchases until levels that they are able to, I don't want to necessarily say afford, but where they see as fair prices. It also keeps employees from providing raises with the idea that they don't need to keep up with the cost of living. You have any thoughts on that?
I mean, that's why the Fed always talks about inflation expectations being more important than inflation. So people become gradually, well, look at Japan. They become inured to an environment of 0.8% inflation, and it becomes what I call the antlion's den. You can never get out of it at that point. So you have to be active enough on the lip of that little hole to keep you to stop from falling in to the sort of vortex of stable, extremely low inflation expectations.
Yeah, and the reason why I bring that up, Brett, was because we were talking about the latest fund manager survey where expectations were starting to rise on that inflation side. I think they're still down at like 11% or something, meaning 11% of people expect to see inflation higher than it is in 12 months than it is now. So that's just one sentiment reading that I'd be continuing to keep an eye out on if you're a big believer in that. So with that, Brett, is there anything on this monetary fiscal debate that I'm leaving out at the moment that you wanted to touch upon? I mean, obviously, we're going to continue to discuss this a lot in this segment. I think it's going to be pretty important. I think it's going to really lay out the framework of how central banks work as we go into the 20s, into the 2020s. So, anything to add?
Yeah. So the main point then to me is if we're willing to say right now that this is a real thing, this is a real problem, that the world over there is a loss of faith in, the voodoo god is dead. There's a loss of faith in traditional tools of monetary policy to really have the bazooka impact at this point, that it's been demystified. Then if we're willing to believe that, and that there's going to need to be some contribution of stabbing the person in the shoulder rather than the voodoo doll in the shoulder, the fiscal policy response, opening up the fiscal channel or going direct, as it's framed in this paper. If we're willing to believe that, then there's going to be a dispersion of opportunities on both sides that have to do with where fiscal policy is more possible, where different systems that have either the balance sheet situation or the political system that allow for active fiscal policy relative to others. And one of the points that I've made in this Euro short idea is that the Eurozone is peculiarly poorly situated for fiscal policy response, given its balance sheet rules for membership in the European Monetary Union and the lack of a fiscal union, and that can play in both directions, because if they're really taking this seriously, they've got their own research going there. If this could be the catalyst to get them to move toward a fiscal union so that they can use the tools that suddenly everybody else is going to be using. And that could mean that European assets are actually significantly undervalued right now, and that my thesis short the euro is wrong, because it's also the opportunity to upset that seeming stable equilibrium. So there is a difference around the world in who's able to use the non-voodoo tools. We've gone a long period of history with no real sense that we need to be using those new, different sorts of tools, more direct tools. And this transition then is going to be a learning experience for investors and markets, generally speaking. And one of those big questions is, which systems are going to best execute.
Yeah, and I think it will be worthwhile keeping an eye on Italy's negotiations with the EU on fiscal rules, which will be going on over the next couple of months. That's going to be one of the key items for the markets that are watching, particularly for that euro trade of yours. Are you concerned at all about some of the headline risk on that, Brett?
No, I mean, one of the things that I posted earlier is there's obviously, it has to be taken into consideration that the euro and these expectations all play toward a lower likelihood of inflation in the future. So if you take, I mean, there's almost a canceling out effect, but I don't think that there is, because I think that there's an existential thesis. So there's almost a canceling out effect, and that is that Europe then would be the one least likely to experience inflation expectation adjustment if they were the ones least able to apply something like what this Blackrock paper is arguing for as a shift in policy. And that would mean that they're the best place to borrow long-term funding for funding currency usage for speculative investment in other markets. So you would borrow and know that you're not going to see as, a sudden jump in the value or in shifting, tightening, for instance, for the ECB, and rising interest rates and rising inflation. The same thing that we saw with Japan in the last couple decades now becomes something you might see as a case for Europe, because it's even more difficult for them to generate the same change in inflation expectations as in other places. And that makes the euro very susceptible to be seen as a very good funding currency for speculation. And what that means is that if you get risk entering the system, you get put-call ratio going up, you get the VIX going up, you usually get the funding currencies rallying very hard, like we see the yen move contrary to risk assets, because you have people closing out those speculative positions and returning their euros or yen or whatever. So you get this kind of the closing out of those funding currency positions. So that would mean that there could be a countercyclical element providing for a big rally in the euro if things start to roll over, which would be a vulnerability to my position. But one of the things I noted today is the yen is a whole lot stronger than the euro in the face of some of the headlines that we've seen. And the pattern in the yen suggests that too. So it may be that we haven't seen, even though it may become the big funding currency in the world, that may still be a ways off and maybe at the bottom that I cover into, but maybe yen is still dominating there.
All right. Well, Brett, I think that's going to do it for our piece here. As always, pleasure talking to you, and we look really look forward to continuous monetary policy, fiscal policy discussion moving forward and how that could impact some of the sentiment and flows that we are seeing here. But Brett,
Sure.
we'll be in touch with you, I'm sure. Looking for your commentary, and I'll talk to you soon.
You got it. Thank you very much, Gavin.
Okay, talk.
Take care.